Welcome to today's explainer. Right now, literally as we speak, global financial markets are completely frozen. It's like a giant coiled spring just waiting to snap. The world's largest institutional investors, the real movers and shakers of the global economy, have abruptly snapped their wallets shut. They are holding their breath. Why? Well, they're waiting on a massive macro data drop, a release so absolutely crucial that it could reshape the trajectory of global wealth for the rest of the year. So today, we're going to unpack exactly what this event is, what the early warning signs are telling us, and how you can actually prepare for the storm that's brewing. Let's take a quick look at our roadmap for tonight's volatility. We'll kick things off with a market overview, zero in on the NFP focal point, check out the early warning signs, map out our trading scenarios, and then wrap up with an actionable strategy. All right, starting with part 1, market overview, the big freeze. So beneath the surface of this freeze, institutional money is nervously shuffling around. Just look at this stark divergence we saw right before 2030 Vietnam time. On one side, you've got buyers rushing headfirst into the Nasdaq 100, pushing the index up by 1.1%. But then, right next door, massive capital completely bailed on the Dow Jones, triggering a 1.25% plunge. That sudden drop totally wiped out all of the Dow's recent attempts to establish a new peak. It's just a wild, severe split in market sentiment right now. And it's not just a US phenomenon either. The signals everywhere are totally mixed up. The S&P 500, it saw a much lighter drop, just about 0.5%, mostly because quick buybacks stepped in to cushion the blow. But then you cross the Atlantic and it's a totally different universe. European markets are basically shrugging off all this anxiety, just casually maintaining their record highs. It's a completely fractured global picture. Now, on the flip side of that European optimism, things look pretty grim. Over in Asia, the JP225 is under immense, crushing pressure. We're seeing a massive wave of capital just fleeing semiconductor stocks. And this panic, it's acting like a heavy anchor, dragging the whole regional tech sector down while the rest of the world just kind of waits. Which brings us to part 2, the NFP focal point, the macro blockbuster. So what's actually causing this multi-continent freeze? It's tonight's Nonfarm Payrolls report, commonly known as the NFP. And guys, this isn't just your standard data release. This is literally the macro blockbuster of the entire month. It's a make or break metric for the markets. The whole reason these massive institutions have frozen their spending is because this specific jobs report is going to dictate exactly what the Federal Reserve does next with interest rates. The whole game hinges on this single piece of paper. So what are the experts bracing for? Well, Wall Street's current expectation is sitting at just 80,000 new jobs created in the US for July. Let's put that in perspective. 80,000 is a dramatically low number. Actually, it's considered a highly alarming level of decline for the US economy. And that leads us to the second massive metric in this report, the unemployment rate. Right now, market experts are projecting it to hold steady at 4.2%. Now, when you pair that incredibly low 80,000 jobs number with a 4.2% unemployment rate, you are painting a picture of an economy that is slamming its foot heavily on the brakes. Let's jump to part 3, early warning signs, the cooling labor market. Wall Street definitely didn't just pull that 80,000 estimate out of thin air. The cracks are already showing up everywhere. ADP private payrolls absolutely plummeted to a mere 44,000 jobs. I mean, that's barely a blip. Pair that with a severe drop in the ISM Services Index, and we've got concrete proof that the US labor market is cooling down. And it's doing it fast. Moving on to part 4, trading scenarios, the high probability path. Let's look at how the market might actually react tonight, specifically zeroing in on Wall Street's highest probability outcome. Here is the primary optimistic scenario. The jobs number lands right in that 70,000 to 80,000 pocket. In this path, the labor market softens just enough to cool things down, but it doesn't totally fall off a cliff. This is the absolute Goldilocks zone for market bulls. Why? Because it hands the Federal Reserve the perfect golden excuse to kick off a monetary easing cycle. In plain English, they finally start cutting interest rates. If that specific scenario plays out, the reaction is going to be predictable but super powerful. In fact, the US dollar index, the DXY, is already flashing some early signs of weakness. If the Fed gets its excuse to cut rates, the dollar slides, and all that frozen institutional cash we talked about, it likely floods straight back into the stock market, driving a massive rebound, especially in tech. Gold also looks incredibly attractive if this happens. Analysts are laser focused on a very specific level here, the 4,190 US dollars per ounce support zone. The expectation is that gold might actually take a quick dip to test this 4,190 level before catching a serious bid and bouncing significantly higher. Finally, part 5, actionable strategy, surviving the volatility. Look, understanding the big macro picture is fantastic, but knowing how to survive tonight's drop is what's actually going to preserve your capital. You have to be incredibly careful. The exact second this news drops at 1930 Vietnam time, the market is not just going to smoothly pick a direction and go. No way. It's going to trigger absolute chaos. We're talking violent, erratic price swings purely designed for two-way stop-loss hunting. The trading algorithms will wildly whip prices up and down, intentionally wiping out tight positions on both sides of the trade before they even establish a real trend. So here is your ultimate survival strategy for tonight, straight from the analysts. Avoid high margin positions entirely. To step aside, drop the leverage, and wait. Let the algorithms fight it out. You really want to wait at least 30 minutes, so wait until after 20 Vietnam time, letting the market actually digest the data. Only then should you start looking to follow the real flow of the big institutional money. This stage is totally set. The big money is waiting, and global markets are literally holding their breath. So the only question left is this. Will tonight's 80,000 jobs expectation be the spark that ignites a massive rate cut field rally? Or will a surprise number completely shatter expectations and plunge this global market correction into something far more severe? We're all going to find out at 1930. Thanks so much for joining me for this explainer. Stay safe in the markets tonight, and I will see you next time.